Welcome to this lecture on the average cost of inventory method using a periodic system as part of Stratfield Solutions' Understand Financial Accounting in 5 Minutes mini-series. A quick word before we jump into the average cost method itself. We need to look at whether or not we're using a perpetual versus periodic basis when evaluating this costing system. You can use either with the average cost method. However, if you are doing this with a perpetual basis, it tends to be more complicated, or at least you are required to do quite a few more calculations, as you have to calculate a different weighted average after each sale. The periodic basis does not have that assumption. We just look at the end of the period and we'll take our average as it stands at the end of the period, whether that be a month or a year end. And so for this lecture, we'll be presenting the weighted average cost method using that periodic assumption only. Again, it tends to be a little more common in financial accounting textbooks, and it can also be explained in 5 minutes. The perpetual system would take quite a little bit extra time and not part of the 5 minutes mini-series. All right, so back to the average cost itself. The purpose. The average cost method can be an effective way to measure the cost of goods sold and ending inventory over a period. Just like LIFO or FIFO, it's a inventory costing method. And it eliminates some of the extremes from large price changes in firms that use FIFO or LIFO. So if I have a large span during the period, the average cost would help me find a middle or average value to apply to the inventory. It is acceptable under the generally accepted accounting principles used mostly in the United States, as well as the International Financial Reporting Standards, or IFRS, used internationally. Now for the calculations, there are 4 steps that we'll go through to do this calculation. The first is to take all of the items purchased during the period and including the beginning inventory. So all of the purchases plus the beginning inventory is our first step. Then for each purchase of inventory, you take the number of units that were purchased and you multiply it by the cost of those units. You also do the same for the beginning inventory. We take all of those that we've multiplied together from line or step 2, and you add those values together. So now you're going to combine each purchase together into one large dollar amount. And then finally, you divide that large dollar amount by the number of units that were purchased and from beginning inventory. And that would be listed as taking the total from step 3 divided by the number of units from step 1. That will give you the average cost of inventory per unit. To apply that to cost of goods sold, it's very simple. You take the cost of goods sold and multiply it by the average cost of inventory per unit, meaning the number of goods that you sold times the cost of the inventory that we found from the previous slide. For ending inventory, you take the number of units in ending inventory and multiply it by the average cost of inventory, again, that same number that we calculated using the previous slide. So it's helpful to put this into a practice example, so we'll spend the rest of the lecture going through that. This is a firm's inventory flow during the period. It had some beginning inventory, 2 purchases, and 1 sale. The number of units and the cost per unit are listed there. We first, just like this was laid out in the other slide, take all of the items purchased during the period and include beginning inventory. Well, we had 100 units from the beginning, 200 in purchase 1, and 300 in purchase 2. That gives us a total number of units of 600. Now for each purchase of inventory, you multiply the number that were purchased by the cost of those units. You also do this for the beginning inventory. We do the math there, 100 times 12, 200 times 12, 300 times 14, corresponding with those table values. And sure enough, we're going to add all of those up together as part of step 3. This gives us $7,800 is the total cost of the purchases and beginning inventory. And so we take that and we divide it by the 600 units that are in the purchase and beginning inventory that we calculated in step 1. This gives us the average of $13 per unit. We're going to answer the following. What is cost of goods sold? Well, we sold 250 units if you go back to that table, and we know that now the average cost was $13 per unit. That gives us $3,250. The other question would be, what is the cost of ending inventory? Well, we had 600 units to sell. We sold 250. That gives us 350 left over, multiplied by the average cost, 4,550. As a bonus, if you wanted to calculate gross profit, you can find the revenue generated by the one sale that's listed in the table and subtract your cost of goods sold. I'll post the answer in the text below the video. So in 5 minutes, there you have the average cost of inventory method applied to cost of goods sold and to your ending inventory. And hope this video was helpful for you, and check out our website at stratfieldsolutions.com for more of these short lecture videos. Thank you.